Hello and welcome. I'm Suyash Maheshwari and you are watching First Take here on News 9, where we break down the morning action on the D Street. Now, Indian markets opened in the green with Nifty in fact scaling a new record high of 20,977 mark in the morning trade. And both indices are trading higher this morning. Sensex is also about 40-50 points off its day's high. The mid cap and the small cap indices both have also scaled a record high. The Nifty mid cap 100 has surpassed 44,700 sort of levels in the morning trade, whereas the small cap index has surged past 14,600 levels for the very first time. And volatility index India VIX is also down by about 1.22% and currently sits at about 12.5 sort of levels. And this augurs well for the bulls, because a decline in volatility at a time when market has risen so quickly is a good sign for the bulls, and perhaps indicates that the rally is going to continue moving forward. Now, on an event day, typically the market likes to wait on the sideline till the decision of that event comes out and take cues from there. And in terms of events, we have a big one. Reserve Bank of India Governor Shaktikanta Das headed Monetary Policy Committee will announce its decision on the monetary policy today at 10 a.m. So just in a few minutes from now. Now, the broader expectation is that the RBI will maintain the rates for the fifth consecutive time at 6.5%. But, we need to be watchful of what the central bank signals in its tones. A few questions are expected to be answered here. Is RBI still ultra worried about inflation? Now, November-December headline inflation, according to a lot of analysts, is expected to come close to about 6%. Now, will that keep RBI hawkish in its tones? Also, I guess, more importantly, if this will, help them, or if this will make them raise their inflation forecast going forward. But coming back to the market, Nifty is on a stellar run. It's on a 6-week winning streak now, and we have not seen this kind of a run since December 2020. And more importantly, I guess the pace of increase has only increased week on week. So far this week, Nifty is up somewhere around 3.5%. Its best weekly winning run since 2023, and it makes you wonder, where are we headed from now? But to answer that and more, let's bring on our guest, Mr. Amardev Singh. Welcome to the show, sir. Always a pleasure speaking to you here on First Take. Now, the up move has been so quick, and there is a case for taking perhaps some profits off the table now. But then again, heavyweights are still a fair distance away from their 52-week high, the likes of your Reliance, HDFC Bank and so on. And banks have only joined the party now, which also makes a case, that there is perhaps more legs to this rally, isn't it?
Yeah, you rightly put it that it was the financials and the banks. If you look at both Nifty versus Bank Nifty, so Bank Nifty recently breached its all-time highs, whereas Nifty was trading at its all-time highs. So Nifty was anyway relatively in a stronger position, or on a stronger wicket as compared to Bank Nifty. But we've seen that now being compensated by the sharp rally in Bank Nifty over the last few trading sessions. And you rightly said that the heavyweights have started a move. So that's very interesting, because HDFC Bank, the likes of Reliance and ICICI Bank. So these are some of the major heavyweights which ICICI have already had a very good decent rally, but HDFC Bank and Reliance in particular, they've started moving or gaining momentum recently. So that's a very positive sign. And rightly said that these heavyweights have to move in order for Nifty to make any significant, because these two in itself compose close to around 20% weightage of the Nifty. And also, if you look at the broader market spectrum, so we see that stocks trading above their 200-day moving average, that's close to almost 75-80%, which is very high. So that clearly reflects that the bullish momentum is not across some certain specific pockets, but across the board, which has a positive impact. Also, the advanced decline ratio, that also is heavily tilted in favor of the bulls. So these are broader indicators which gives us a sense as to what's the undertone of the market and how strong the undertone is. Apart from that, the RBI policy is there, so it's a status quo which is expected. Yeah, inflationary concerns are there, but it's in a comfortable, I would say, in a sweet spot as far as the inflation is concerned. If you look at crude oil prices, That also has been a blessing for us in the recent the way crude oil prices have corrected. So
Right.
these are good signs, and also the earlier concerns with regard to inflation actually again moving on the upside, that's somewhat contained. So that chatter has also come down. So we'll have to watch out for the positives are there, and yes, Nifty has had a spectacular rally. And the other thing what we need to remember is that there was also a lot of shorts which were built into the system. So we're not expecting that Nifty would breach, say, around the 20,000 level or 20,200 levels. Because once that level was reached, Nifty witnessed almost a 4% rally, 4% rally from those levels. So that was more of short covering which has happened. And also, yes, FIIs have also come in now. So that's also a positive thing. We'll have to see how long this trend continues. Apart from that, the bullish cues definitely are positive. So I think all things are going. And the best part is India VIX remains below the 13-14 mark. So that also currently around 12.7. So that again is a positive thing to look at.
Now, Mr. Singh, to the common man who's not invested in markets, this kind of pace of increase, this rally that we have seen, it may look like the markets is some sort of a Sone ki chidiya. What would be your advice to them?
I would say that, see, you have to remember that if you are in the market, then you have to be in the market for a long period of time to actually make money or create wealth. That's something there is no doubt about it. Secondly, you have to remember that it's not a one shot. It's like a marathon. It's not a 100 meters race wherein you just finish it off and you're done for the day. It's more of a marathon. So you have to have a consistent strategy of investing in the markets, whether the markets are trading at record highs or whether the markets are witnessing a significant correction, because then that's the way you really make money. But for that, you have to understand, again, if you're investing in mutual funds or ETFs, then that's a good way to start. For those who want to get into stock SIPs, then they should have a portfolio of stocks wherein they should be very clear or have a clear sense that this company is going to be there for the next 10, 15, 20 years. That's a mindset which they need to have, because there are so many stocks which are rallying, defying all laws of gravity also in terms of the move. So we should not get caught up in this optimism or I would say enthusiasm. So we should focus on stocks which are fundamentally strong. And yes, then you either build a portfolio or go through the mutual fund or the ETF route. But again, on a sustained basis, on a SIP mode.
And what should be their portfolio allocation? Should they lean towards the large caps now, or mid cap and the small caps? Do they still offer value?
I would say that one should look at more of a multi-cap, because I'm in favor of that, because small caps at these levels, I wouldn't recommend. Mid caps, yes, but having a mix of large cap and mid cap, and to a certain extent a small cap. So multi-cap is a better approach for I would say investors. That would make more sense.
All right. And I also want to get your view on the banking pack. You know, we saw some bit of a consolidation take place on the weekly expiry date for Nifty Bank on Wednesday and Thursday. It was pretty much flattish. But we have surpassed 47,000 levels. We have taken 47K once again. Is the rally expected to continue over there?
Yeah. So if I look at Bank Nifty in particular continues to remain, I would say, extremely strong on the charts, because earlier Bank Nifty was unable to breach the 46,300, 400 zone. It's almost up by 607 points up. And as I said that, like if you look at the likes of Axis Bank is doing phenomenally well. If you look at ICICI Bank, ICICI is one where it has got an interesting, I would say, pattern there. And it's unable to reach its earlier highs of 1020, 1030 zone. That's a zone of resistance for ICICI Bank. So if that is taken out, then we could say that again the next leg of rally is there, because ICICI, HDFC Bank, Axis, SBI and Kotak, these form the major chunk of weightage in the almost 75-80% in the Bank Nifty. So HDFC has started taking off. So that's a good thing. Again, HDFC needs to sustain. If I look at HDFC, so HDFC Bank needs to sustain above the 1670 levels, because that's a zone of resistance from where it had corrected from to almost 1450, 1460 levels. So 1670 is a level to watch out for HDFC Bank, and 1020, 1030 is a level to watch out for ICICI Bank. If these two levels are taken out, and the markets are not very far off from these levels, if these levels are taken out and they sustain above these levels, then we could see a next phase of rally in I would say, Bank Nifty.
Now, keeping it with stocks, one stock that was in action and has been in action for, the last 2-3 days is Paytm. Now, the stock dropped by as much as 20% to hit a lower circuit yesterday. And this morning, we are seeing some bit of a recovery. The stock is currently up about 2% or so. Now, the big crash was on the back of Paytm saying that it's looking to exit the small ticket postpaid loans. The company also said that it will not affect their margins and revenue much, but the kind of movement, the sharp decline we saw in the stock price, is that justified, Amar?
Yeah, I would say if you look at Paytm has got, I would say it's been on a more of a yo-yo sort of movement. The stock has witnessed above 1800 levels, then 400 levels, and then almost 430 levels, and then it bounced back significantly. So if you look at the stock, go back in time, so in exactly the first week of December, it had made a low of around 440. And from there, the stock rallied all the way towards 1000 levels, which is a phenomenal return for investors who would have invested or maybe would have got anywhere when the momentum started picking up. What we are seeing right now is the stock correcting significantly. You rightly said that this week itself, the stock is down by almost 22-23%, wherein we are seeing a record being made on the benchmark indices. So that tells that there are definitely some concerns which have crept in the stock, and also the stock is, I wouldn't say this is profit booking, because in profit booking we don't see such type of fall. And if there is a fall, then there is a pullback also, which we are not witnessing. So that tells me that something is definitely happening in this particular stock. As far as the levels to watch out for, if you go back in time again, somewhere around March of this year itself, the stock had made a low of around 556. So 550-600, that's going to be a zone of support for the stock. And if you look at the long-term trend, I won't say it's negative, but it's more or less consolidation, which is there after the rally that the stock witnessed from 440 levels to almost 1000 levels.
All right. Now, Amar, as we speak, we are just a touching distance away from the 21,000 mark on Nifty. So it's pretty much done and dusted. For December, where do we end? Where do we end this year at?
I would say, what we are seeing is that the way Nifty has managed to sustain above these levels. So 20,000, earlier it was 20,200 and 250 zone, 300, you can say 20,200, 300 zone. It's taken that out like a piece of cake. So it's just trading significantly higher, almost 600, 700 points higher from there. And also the momentum is there. And also if you look at the two major factors, I would say three factors, primarily four factors, which are very crucial. One is that crude oil prices, they continue to remain very low and on the lower side. So that's a positive. So inflationary concerns are not that much of a concern as of today. And secondly, the global markets, the US markets have also been extremely resilient, have bounced back significantly. So there also the positive momentum is there to stay. And thirdly, what we see is that FII flows have started coming in, and whether this trend continues, because ultimately markets are all driven by liquidity. Right. So that liquidity has to be there, and also the liquidity and the sentiment. These are the two factors which really drive markets. So I would say currently we are in both the cases, we are in a positive space. So I would say that for Nifty to levels to watch out for somewhere around 20,500, 600 immediate zone of support if there is a correction. Any correction should be used as a buying opportunity. Till the time we don't see India VIX trading above the 15-16 mark, that would be some concern or some trigger to look at. On the upside, breaching 21,000 levels, then it's definitely significantly trading higher.
Now, Mr. Singh, the market, everything looks hunky-dory. We are, scaling all-time highs, both the broader markets and the headliners pretty much on the daily basis. Gold is at a record high, but rupee is under pressure. In fact, we are at a record low. What gives?
I would say, the RBI has a twin policy. One is to manage inflation, and the second is to manage the rupee. And I think they've done quite well there in that sense that the rupee, though it has not appreciated, which would say around to the 82 levels or so, but it's not depreciated also. So somewhere we are seeing around 83, 40, or so. And it's, if you look at rupee charts, I would say it's someone who's a trader, he wouldn't find much of a trading opportunity, because there's a complete lack of trend. It's more of consolidation. It's more of a range play, and that also within a very narrow range of 40 to 60 paise. So somewhere around, I would say 83 on the downside and 84.50, 84.60 on the upside. That's 83 on the downside and 83.50, 83.60 on the upside. That's the range that rupee has been trading consistently. Talking about gold, yeah, gold has bounced back. So that reflects that investors are also looking at gold as an investment opportunity going forward if there are inflationary concerns, or because crude oil prices from the current levels, I don't think there's much scope for a downside move unless we see.
Amar, hold that thought. We have Mr. Shaktikanta Das speaking live, and the policy decision comes out. Listen in.
If you remember, this was started in October of 2016. So 7 years are complete. We are into the 8th year. And on a personal note, if I can seek your indulgence, this would be my 32nd monetary policy, including the off-cycle meeting last year and a special meeting. And at the outset, let me also wish each one of you a very happy new year in advance. And this is how the statement reads. As 2023 comes to an end and a new year begins, the long-awaited normality still eludes global economy. The years 2020 to 2023 will perhaps go down in history as the period of great volatility, comprising a host of black swan events in quick succession. The global economy is showing signs of slowdown, though unevenly across geographies and sectors. The emerging market economies, that is EMEs, as a group have remained resilient during the current bout of volatility, unlike previous episodes. While headline inflation has receded from the highs of last year, it remains above target in many countries. Core inflation continues to be sticky, impeding the last mile of disinflation. Major central banks have kept rates on hold while refraining from forward guidance in view of the prevailing uncertainties. Financial markets remain volatile in their quest for definitive signals about the future path of interest rates. Against this unsettled global environment, the Indian economy presents a picture of resilience and momentum. The real gross domestic product, that is GDP growth for Q2 of the current financial year, has exceeded all forecasts. The fundamentals of the Indian economy remain strong, with banks and corporates showing healthier balance sheets, fiscal consolidation on course, external balance remaining eminently manageable, the forex reserves providing cushion against external shocks. These factors, combined with consumer and business optimism, create congenial conditions for sustained growth of the Indian economy. Looking ahead, it is our endeavor to further build on these fundamentals, which are the best buffer against global supply shocks in today's uncertain world. Let me now turn to the decisions and the deliberations of the Monetary Policy Committee, which was held, as you know, on 6th, 7th, and today 8th of December. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, of course, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, CPI headline inflation moderated to 4.9% in October from 7.4% in July. The moderation was observed in all components of CPI, namely food, fuel, and core, that is CPI excluding food and fuel. There has been broad-based easing in core inflation, which is indicative of successful disinflation through monetary policy actions. The near-term outlook, however, is masked by risks to food inflation, which might lead to an inflation uptick in November and possibly in December. This needs to be watched for second round effects, if any. Domestic economic activity is holding up well as assessed in the previous MPC meetings and as reflected in the GDP growth for the second quarter of this year. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%, but remain highly alert and prepared to undertake appropriate policy actions as warranted. Monetary policy must continue to be actively disinflationary to ensure fuller transmission and anchoring of inflation expectations. The rate action so far is still working its way into the economy. Hence, the MPC decided to remain focused on withdrawal of accommodation to ensure that, as I have already stated, to ensure that inflation progressively aligns to the target while supporting growth. I would now like to provide an assessment of the growth and the inflation situation. First, let me focus on global growth in brief. The global economy continues to remain fragile. World trade is decelerating amidst global tide of protectionism. Despite significant restoration of global supply chains, factors like elevated debt levels, lingering geopolitical hostilities, and extreme weather conditions aggravate the risks to global growth and inflation outlook. Easing of inflation in advanced economies has led to expectations of an early end to the monetary policy tightening cycle, shoring up market sentiments. Sovereign bond yields are softening as markets are not factoring in any further rate hikes. Coming to domestic growth, economic activity in India exhibited buoyancy in the second quarter of this year, aided by strong domestic demand. GDP growth, as you would know, posted a robust growth of 7.6% in the second quarter of this year, that is 2023-24, driven largely by investment and government consumption. Turning to the third quarter, two-thirds of Rabi sowing has been completed despite late harvest of Kharif crops in some states. Manufacturing sector gained strength with easing input cost pressures and pickup in demand conditions. 8 core industries recorded healthy growth in October and continued their high growth since June this year. The Purchasing Managers Index, that is the PMI for manufacturing, rose in November. The services sector buoyancy has remained intact as reflected in the high frequency indicators which the Reserve Bank monitors. GST collections at rupees 1.68 lakh crore in November 2023 were also buoyant. Services PMI displayed healthy expansion in November. In my statement, there is a lot of data available which I have put in the footnote, so those of you who are interested can have a look at the footnotes. The entire data in support of whatever I am saying is available in the footnotes. On the demand side, households' consumption is supported by durable urban demand and gradual turnaround in rural demand as reflected in sales of fast-moving consumer goods, that is FMCG, and other indicators. Festival-related demand is also spurring household discretionary consumption in the third quarter, that is in the current quarter. Investment activity continues to be aided by buoyancy in public sector capex. This is also reflected in strong growth in steel consumption, cement production, and imports of capital goods. Capacity utilization in the manufacturing sector continues to remain above the long period average. Investments in fixed assets by listed private sector manufacturing companies also registered healthy growth in the first half of 23-24, primarily driven by key industries such as petroleum, steel, chemicals and cement. The total flow of resources to the commercial sector from banks and other sources at rupees 17.6 lakh crore during the current financial year so far is significantly higher than that of last year, which was at rupees 14.5 lakh crore. Despite weaknesses in external demand, both goods and services exports returned to positive territory during the month of October this year. Looking ahead, private consumption should gain support from gradual improvement in rural demand, strengthening of manufacturing activity, and continued buoyancy in services. The healthy twin balance sheets of banks and corporates, high capacity utilization, continuing business optimism and government's thrust on infrastructure spending should propel private sector capex. The drag from external demand is also expected to moderate with a turnaround in merchandise and services exports. The protracted geopolitical turmoil, volatility in global financial markets, and growing geoeconomic fragmentations, however, pose risks to the outlook. Now, taking all these factors into consideration, real GDP growth for the current year, that is 2023-24, is projected at 7%. I repeat, real GDP growth is projected at 7% for the current year, with the third quarter at 6.5% and the fourth quarter at 6%. Real GDP growth for next year, and we have provided the figures for the first three quarters of next year. So real GDP growth for the first quarter of 24-25 is projected at 6.7%, for Q2 at 6.5% and Q3 at 6.4%. The risks are evenly balanced. I would now like to turn to inflation. Food inflation, which was in double digits in July, has since then moderated to 6.2% in October with correction in vegetable prices. Fuel inflation slipped into deflation since September, primarily reflecting the sharp fall in LPG prices in end August. The disinflation in core gathered momentum during September-October and reached levels last seen in the fourth quarter of 2019-20 due to the combined effect of policy rate increases and reduction in cost push pressures across core goods and services. Going ahead, inflation outlook would be considerably influenced by uncertain food prices. High-frequency food price indicators point to an increase in prices of key vegetables, which may push CPI inflation higher in the near term. The ongoing Rabi sowing progress for key crops like wheat, spices and pulses needs to be closely monitored. Elevated global sugar prices is also a matter of concern. On the positive side, global commodity prices, particularly agricultural commodities, have softened except rice. For highly import-dependent food items like edible oils, international prices continue to remain soft. Domestic milk prices have stabilized. Proactive supply-side interventions by the government are also containing domestic food price pressures. Crude oil has softened considerably, though it may remain volatile. Taking into account these factors and on the assumption of normal monsoons, CPI inflation is projected at 5.4% for the current year, that is 2023-24, with the third quarter at 5.6% and the fourth quarter at 5.2%. CPI inflation, and here again we are giving for the first 3 quarters of next year. CPI inflation for the Q1 24-25 is projected at 5.2%, Q2 at 4%, and Q3 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? Let me provide our assessment. We have made significant progress in bringing down inflation to below 5% in October 2023, despite occasional blips due to intermittent supply shocks. The summer of 2022 is behind us. Our policy of prioritizing inflation over growth, hiking the interest rates, that is policy rate, by 250 basis points in a calibrated manner, and draining out excess liquidity have worked well, alongside supply side measures taken by the government to bring about this disinflation. The fact that core inflation has also trended lower and household inflation expectations have become better anchored gives us the confidence and conviction that monetary policy is doing its job. On the other hand, growth remains resilient and robust, surprising everyone on the upside. Notwithstanding this progress, the target of 4% CPI is yet to be reached, and we have to stay the course. Headline inflation continues to be volatile due to multiple supply side shocks, which have become more frequent and intense. The trajectory of food inflation needs to be closely monitored. Intermittent vegetable price shocks could once again push up the headline inflation in November and, as I said, possibly December. While monetary policy would look through such one-off shocks, monetary policy has to stay alert to the risk of such shocks becoming generalized and derailing the ongoing disinflation process. In the midst of these uncertainties, monetary policy has to remain actively disinflationary to ensure a durable alignment of headline inflation to the target rate of 4% while supporting growth. I would now like to focus on the liquidity and financial market conditions. Like most other central banks, the Reserve Bank had injected additional liquidity into the system to counter the COVID-related onslaught on our economy. Consequently, the size of the Reserve Bank's balance sheet had expanded significantly. Persistence of such expanded balance sheet far too long could have created macroeconomic and financial instability. It is worth noting that the Reserve Bank has successfully reduced its balance sheet size well in time. Illustratively, the size of Reserve Bank's balance sheet swelled to 28.6% of GDP in 2020-21. With modulation in liquidity in the post-COVID period, the balance sheet size moderated to 23.3% of GDP in 2022-23 and further to 21.6% in the current financial year up to December 1. We consider this as a significant achievement. System liquidity as measured by net position under the Liquidity Adjustment Facility, that is LAF, turned into deficit mode for the first time in September this year, after a gap of nearly 4.5 years since May 2019. Deficit liquidity conditions persisted during October and November, prompting large recourse to marginal standing facility, that is MSF, by the banks. In parallel, utilization of standing deposit facility, that is SDF, has also been high. The overall tightening of liquidity conditions is attributed mainly to higher currency leakage during the festive season, government cash balances, and Reserve Bank's market operations. Driven by these autonomous factors, system liquidity tightened significantly compared to what was envisaged in the October policy statement. Consequently, the need to undertake auction of OMO sales has not arisen so far. The evolution of liquidity conditions has been in alignment with the monetary policy stance. More recently, however, as government spending has picked up and system liquidity has got more evenly balanced among market participants, pressures have eased and the net LAF position has evened out broadly. Going forward, government spending is likely to further ease liquidity conditions. On our part, the Reserve Bank will remain nimble in liquidity management. Now, different segments of the financial markets have witnessed monetary transmission of varying extent. Long-term G-Sec yields have softened, reflecting strong demand for these bonds from financial institutions and softening of global bond yields. In the credit market, monetary policy transmission is still working its way through the system and the supporting data is provided in the footnote. With regard to standing facilities of the Reserve Bank under the LAF, we have noticed, as I pointed out, we have noticed simultaneous high utilization of both MSF and SDF by the banks. This was also pointed out by me in the last monetary policy statement. We propose to address this situation and have therefore decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30, 2023. This is an important announcement so far as the banks and the liquidity situation is concerned. So let me just read it again. We have decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30 this year, that is December 30, 2023. It is expected that this measure will facilitate better fund management by the banks. This measure will be reviewed after 6 months or earlier if needed. The Indian rupee has exhibited low volatility compared to its EME peers in the calendar year 2023, despite elevated US Treasury yields and a stronger US dollar. The relative stability of the Indian rupee reflects the improving macroeconomic fundamentals of the Indian economy and its resilience in the face of formidable global tsunamis. Recently, the Reserve Bank and the Bank of England have signed a memorandum of understanding on cooperation and exchange of information relating to the Clearing Corporation of India, which is a central counterparty that is regulated and supervised by the Reserve Bank. The MOU will enable the Bank of England to assess CCIL for recognition as a third country CCP, that is central counterparty, for UK-based banks to clear their transactions through CCIL. This MOU is based on the principles of mutual cooperation and trust among the regulators of both the countries, that is India and England. We hope the regulators of other jurisdictions also accept these principles. Financial stability, I would now like to just focus briefly on the aspect of financial stability. Financial stability, as we have stated before, is a public good. The Reserve Bank judiciously uses micro and macro-prudential tools to safeguard financial stability. The recent preemptive measures taken by the Reserve Bank in respect of banks and NBFCs were geared towards addressing potential risks and preserving the resilience of the financial sector. We do not wait for the house to catch fire and then act. Prudence at all times should be the guiding principle, should be the guiding philosophy, both for the regulators as well as the regulated entities. I now propose to turn to the external sector. In October this year, both merchandise exports and imports came back to the expansionary zone. Services exports remained buoyant during the second quarter of this year. India has remained the top remittance receiving country. The net balance under services and remittances is expected to partly offset India's current account deficit and keep it within the parameters of viability. On the financing side, foreign portfolio investment, that is FPI flows, have seen a significant turnaround during the current year, with net FPI inflows of US $24.9 billion up to December 6, as against net outflows in the preceding 2 years. Net foreign direct investment, that is FDI, on the other hand, moderated to US $10.4 billion in April-October this year from US $20.8 billion a year ago. Net inflows under external commercial borrowings, that is ECBs, and non-resident deposit accounts are, however, much higher than last year. India's external vulnerability indicators exhibit higher resilience in comparison with EME peers, as well as since the taper tantrum period. India's foreign exchange reserves stood at $604 billion US as on 1st December 2023. We remain confident of meeting our external financial requirements comfortably. I would now like to announce certain additional measures. First one relates to review of regulatory framework for hedging of foreign exchange risks. The regulatory framework for foreign exchange derivative transactions was last reviewed in 2020. Based on market developments and feedback received from market participants, the extant regulatory framework for forex derivative transactions has been refined and consolidated under a single master direction. This will further deepen the forex derivatives market by enhancing operational efficiency and ease of access for the users. The next announcement relates to framework for connected lending. The extant guidelines on connected lending are limited in scope. It has been decided to come out with a unified regulatory framework on connected lending for all regulated entities of the Reserve Bank. This will further strengthen the pricing and management of credit by the regulated entities. The next announcement relates to regulatory framework for web aggregation of loan products. The Reserve Bank had introduced the regulatory framework for digital lending in August-September 2022. The digital lending ecosystem also comprises of services that aggregate loan offers from various lenders, and this is called web aggregation of loan products. Now, this is meant for the guidance of the customers. It enables the customers to decide which loan product to opt for. Several concerns relating to such web aggregation of loan products which harm consumers' interest have come to our notice. It has therefore been decided to lay down a regulatory framework for web aggregation of loan products. This is expected to result in enhanced customer centricity and transparency in digital lending. Next announcement relates to setting up of a fintech repository. Financial entities like banks and NBFCs in India are increasingly partnering with fintechs. For better understanding of developments in the fintech ecosystem and to support this sector, it is proposed to set up a fintech repository. This repository will be operationalized by the Reserve Bank Innovation Hub in April 2024 or earlier. Fintechs would be encouraged to provide relevant information voluntarily to this repository. The next announcement, there are two announcements relating to UPI. The first announcement relating to UPI is for enhancing the UPI transaction limit for specified categories. The limit for various categories of UPI transactions have been reviewed from time to time. It is now proposed to enhance the UPI transaction limit for payment to hospitals and educational institutions from rupees 1 lakh to rupees 5 lakh per transaction. This will help the consumers to make UPI payments of higher amounts for education and healthcare facilities, for education and healthcare purposes. The second announcement relating to UPI relates to, it relates to e-mandates for recurring online transactions. It's actually, it's a much broader announcement. It relates to e-mandates for recurring online transactions, and specifically it focuses on enhancement of limit for specified categories. E-mandates for making payments of recurring nature have become popular among customers. Under this framework, an additional factor authentication is currently required for recurring transactions exceeding rupees 15,000. It is now proposed to enhance this limit to 1 lakh rupees per transaction for recurring payments for mutual fund subscriptions, insurance premium subscriptions, and credit card repayments. This measure will further accelerate the usage of e-mandates. So strictly speaking, this is not a part of UPI alone. It's a wider, it has got wider ramifications. And the last announcement that I have, it relates to establishment of a cloud facility for the financial sector in India. Banks and financial institutions are maintaining an ever-increasing volume of data. Many of them are utilizing the cloud facilities for this purpose. The Reserve Bank is working on establishing a cloud facility for the financial sector in India for this purpose. Such facility would enhance data security, integrity, and privacy. It would also facilitate better scalability and business continuity. The cloud facility is intended to be rolled out in a calibrated fashion over the medium term. I would now like to conclude. In a global economy clouded by uncertainties, monetary policy actions and communication can be a stabilizing force by anchoring the expectations of economic agents. Clarity and consistency in action and communication is a time-tested principle for effective monetary policy. Policymakers have to be mindful of the risk of being carried away by a few months of good data, or by the fact that CPI inflation has come within the target range. They have to be also mindful of the risk of over-tightening, especially when large structural changes, geopolitical and geoeconomic shifts are taking place. On top of this, they have to be watchful of the risks from new shocks that could hit the economy from anywhere, anytime. We have now reached a stage when every action has to be thought through even more carefully to ensure overall macroeconomic and financial stability, more so because the conditions ahead could be fickle. We have to remain vigilant and ready to act as per the evolving outlook. India is better placed to withstand the uncertainties compared to many other countries, as the Indian economy trades the path to a brighter future. I recall the wise words of Mahatma Gandhi, and I quote, "Progress is absolutely assured whenever there is an unalterable determination." Thank you. Namaskar.
And progress will be ensured. Those are the words of RBI Governor Shaktikanta Das as he discusses the outcomes of the bi-monthly monetary policy meet. The RBI has kept repo rate unchanged at 6.5%. Welcome back. You're watching Business Plus. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. First up, let's begin with headlines. RBI hits the pause button on interest rates once again, maintains focus on withdrawal of accommodation. And India to take a light touch approach to regulating AI. Government clarifies day after social media companies ring alarm bells on regulations. In a fresh blow to Indian diamond industry, G7 nations mull banning imports of polished diamonds from Russia to impact India's exports of diamonds. Government allows non-basmati white rice exports to 5 African countries, eases export curbs to allow specific quantities of exports to select countries. And China's exports expand for the first time in 6 months, suggesting factories in China are attracting buyers through discount pricing. And popular painkiller Meftal can have adverse reactions. Government issues alert, says closely monitor the possibility of possible systemic symptom syndrome. Those are the big stories we are tracking here on Newsline. With me is Krishna Kumar. Krishna, very good morning. Very important story that is coming by the way of RBI's bi-monthly monetary policy decision. We are inching close to our target for inflation. However, the big headline for me is that the GDP growth for financial year 24 is now changed to 7% from 6.5% to 7%. That is, of course, as per the RBI.
Right, the right green arrows and the right red arrows, isn't it? We want inflation to keep going down. We want GDP to keep going up. The macro economic indicators are absolutely fine. It is for the 5th time, bear in mind, in the last 10 months that we've seen the policy rate being held. February 2023 was when the rate was up from 6.25% to 6.5%. And it's the 5th time that the rates have been held, and that's an important indicator. There's a message being sent out by India's RBI governors that policy makers should not be swayed by data on a monthly basis. They should wait for data to settle down. An important message. That's what India is doing. India is sending out a message by neither cutting down rates nor hiking interest rates. It's all about keeping it and holding it and waiting for macroeconomic indicators to be strong enough. And he said, despite the fact that India has got inflation finally within the target range, and if any worries about a less than 7% GDP being erased, time would have been ripe for India to cut interest rates. What is the issue over here? But we've held interest rates, and we're sending a message out to policymakers across the world through our RBI governor about how to react to macroeconomic data arriving at this time. He uses words like the way forward could be fickle, the future could be fickle, so you need to be very steady in your policy and decision making. So that's reflected in the fact that it's for the 5th time the rates have been held. This year.
And withdrawal of accommodation there. What's also interesting is that the CPI inflation, the target is still 5.4%. So the governor not very happy with the way inflation is inching. He also hinted at the fact that food inflation could perhaps be a dampener going forward. It has been a dampener in the past couple of months. Food inflation has remained double-digit despite government efforts month on month.
And also the problem with the food inflation, one is internal supply chain concerns, and the second is the fact that the erratic rainfall that affects different parts of India differently. Somewhere there's deficient rainfall, somewhere there's excess rainfall, because of which crops get damaged, crops don't get enough water. So all of this, poses a problem for food prices to come down. I mean, the hope is that the monsoons from here on sort of average out, and you get a crop that meets expectations of the market. So the problem with food inflation to me at this stage is the weather vagaries, and of course the challenges that we deal with as far as our internal supply chain within the country is concerned. Yes, but the fact of the matter is that it's not like all the concerns have gone away. That's precisely the reason that the rates have not been cut down. The rates have been held, which is basically RBI saying the best thing to do would be now is to wait and watch.
Absolutely. And as far as CPI inflation is concerned, forecast for October to December is retained for this year, retained at 5.6%. Forecast for January to March is also retained at 5.2%. Overall forecast for the year retained at 5.4%. For growth, there's been a revision solely on the back of the fact that Q2 of financial year 24 has been extremely well. The results have been very well. Results have basically been better than expectations at 7.6%, and that has resulted in the GDP growth forecast changing for the overall year. Also for October to December, it stands revised at 6.5% from 6%. For January to March at 6% overall for the year, as opposed to 6.5%. The country is expected to grow at 7%. So good news coming in by the way of RBI Governor's statement on the back of the bi-monthly monetary policy. Remember, the rates are unchanged for the 5th consecutive time. There is a pause button. Hopefully, a rate cut perhaps sometimes next year. That is the big expectation.
Well, the way Shaktikanta Das, our RBI Governor, is speaking is unlike, say, even the feelers.
Quoting Gandhi.
Mainly in say comparison to the US Central Bank, which is the US Fed, where we've been hearing about a possible rate cut by FY24, a possible rate cut coming up soon. That's not the signal he's sending. The signal he's sending is that if there's a rate cut, we'll let you know. As of this monetary policy review is concerned, we are not cutting rates. So it's as he said, the future is fickle. There's no it's very difficult to peer into when is the possibility that the RBI will go ahead and cut interest rates. But what is important to note here is that as macroeconomic indicators improve, India has held its interest rates. India is in fact sending a signal to all central banks across the world about what is the right way to react to macroeconomically. Just because we got 7.6% in the last quarter.
Take a long-term approach as opposed to taking a tunnel vision of the data that is coming in.
Not a knee-jerk approach to macroeconomic data, so to speak. Look at the macroeconomic data, be happy about it, but really wait for it to settle down.
And before we move forward, let's also quickly take a look at how the markets are reacting to the latest updates that have come in by the way of MPC. In markets, of course, bulls are running amok. Nifty touched 21,000. It's at 20,985 at the moment. Sensex at 69,792 at the moment. So markets are in the green. They've taken positively to the news after snapping their 7 days winning session yesterday. Markets reacting positively to the RBI's MPC takeaways. But with that, let's move on to a story that is coming in by the way of regulations on AI. A day after government and a day after social media policy, companies like Meta and Google said that they're wary of what could come in by the way of regulations of AI and whether that would hamper innovation in AI. Government says there's going to come up with light touch approach to regulating AI. Essentially, there will be no sweeping regulations, so you need not worry. There will be room for innovation.
Right, and that's an important message being sent out at this particular stage, because that's the fear. Because with all the talk around deep fake and AI posing problems, posing a major challenge to society, and we have an election coming up, there's so much scrutiny and talk of why is AI not regulated, why is AI not reined in, so to speak, if it can affect society so much. Anything from deep faking an actress to people to our very own Prime Minister. So in that kind of an environment for the Indian government to say, yes, we are looking at having overarching regulations, but the idea is to encourage innovation. Because let's face it, India has a role to play in both the development of AI technology going forward and its applications, considering the number of people who will benefit from technology made by India for large masses of people, and also to regulation as well, how to regulate. The same way we are sending message on how to correct interest rates or keep interest rates or hike interest rates or cut interest rates, how to react to macroeconomic data. We're also sending a message on how to react to this scorching pace of growth of artificial intelligence and how to deal with it. The moment technology has this burst, the idea should not be to clamp down on it quickly, because there's so many youngsters out there, there's so many startups, there's a great opportunity here for India.
And the money that is coming in for development of AI in India. The fact that India's IT sector is extremely robust and going big towards AI, and there are, as you rightly pointed out, there are a variety of startups that are hoping to leverage AI, and so the investment money that is coming in, that may be put to a halt if there are drastic regulations. Those, of course, were the fears of Meta and Google.
Right, of course. Meta and Google are operating at a different level. We're looking at they're asking for a United Nations. Sam Altman is asking for a United Nations for artificial intelligence. Bear in mind, there's a guy called Elon Musk involved in the scheme of things. So at a global level, that's what's happening. That's why at the G20 presidency of India was very clear about sending a strong message about regulating AI globally. I was one of the stated intents of the G20 presidency. So the global regulations, bear in mind, it's not like the US and the European Union are not working on what they're they're doing. They are, but they're still at a very early stage. Even when it comes to something as specific as deepfake. How do you counter deepfake? How do you regulate deepfake? And how do you make sure, do you put a watermark on it? How do you you go to the source? There's still such lack of clarity on how we're going to even control deepfake. Leave alone, regulations for AI that regulated at the same time allow for creativity to burst forward.
Absolutely, and the government is now clarifying at the moment that there will be regulations, but they will be light touch regulations. Essentially, it's important that the positives of the regulations will greatly outweigh negatives, and hopefully the regulations will not put a stop to the money that is flowing in as far as AI development in India is concerned. There will be room for innovations. That's the message coming in from the government. This comes a day after various social media heads in India pointed out at how regulating AI could be a dampener to AI's progress in the country. Remember, Government of India expected to roll out some sort of interim regulations in light of the recent deepfakes, as Krishna rightly pointed out, have emerged on social media, have literally stormed social media sites, and people, and very believable deepfakes that people have pointed at, and all of this has resulted in red flags been shown to the government on a need for a fast regulation. Hopefully will come up this week itself. But shifting focus to India's diamond industry, which is also has been struggling for a while now, in a fresh blow, and what could come as a fresh blow, G7 nations are now saying that they may ban imports of polished diamonds from Russia. Russian roughs will not be allowed in India and other G7 nations. This essentially means that India, the diamond industry, fledgling diamond industry, which is already struggling with a lot of absence of enough rough cut diamonds, will have further restraint on what it can export to different countries.
Right, and this even as its own exports are facing difficult times because the demand, because of the fall in demand from China, the fall in demand in the US, the fall in demand even in the Western markets across the board has impacted Indian exporters a lot, and now sourcing has become a concern. So that makes it a double whammy for Indian diamantaires. India, bear in mind, is the largest exporter of cut diamonds, rough cut diamonds, and you name any of the diamond hubs in the world, say for example Belgium and Brussels, you see over there's a huge Indian population who have been working there for decades and decades. So the diamond industry is an important part of India's own export story, India's own commerce history from a very, very long time. And now, particularly, Shweta, as you're rightly pointing out, it's going through multiple issues. First of all, it needs to see where it can continue exporting, where exports can come, how exports can be increased. And also bear in mind, India is also finding alternatives with the lab manufactured diamond and the promotion of the lab manufactured diamond, that India can pioneer and can be a pioneer and have an early mover advantage when it comes to lab manufactured diamond. So clearly this is a huge churn moment as far as India's own diamond export industry is concerned.
All right, the G7 nations, they're looking at perhaps some sort of an import curb on Russian rough cuts. Essentially means the supply of rough cuts to India could take a halt, could take a beating in days and months to come. The fledgling diamond industry, which exported about $22 billion worth of diamonds, primarily to US, South Africa, followed by Japan, is likely to take a further beating. But shifting focus from diamonds to rice, one of the essentials that India had put a curb on, the non-basmati white rice exports for a few months now in order to ensure that there is enough supply within the country. The government is now looking at removing some of those curbs, specifically for 5 African countries as well as Nepal. Nepal will get certain sums of rice from India, non-basmati white rice. But 5 African countries looking and staring at getting certain fixed quantity of non-basmati white rice, making an exception there for Africa.
Right, and they're what I call is key and strategic partner nations. And key and strategic partner nations, we've seen India already remove the curbs for a bunch of Asian and African nations just a few months ago. Bear in mind, the curbs were implemented in July 2023 to make sure prices don't shoot up in the domestic market. And since then, we've seen step by step lifting of curbs, need-based, where there's actually going to be a shortage of food. So this is like in a sense an act of goodwill by India to countries. So the countries include the likes of Madagascar, you have Equatorial Guinea, you have Comoros, you have Egypt and Kenya. So these are the countries, these are the beneficiaries. Kenya will be getting the maximum chunk of it all at around 100,000 tons, and Egypt will get about 60,000. Madagascar will get about 50,000 tons. So that's the kind of numbers that we're looking at, around 240 odd tons of rice, non-basmati white rice being exported. Bear in mind, India did two things. One was completely banned the export of non-basmati rice in July 2023, and in August 2023, it had put a minimum export price on basmati rice exports at a steep $1,200 per ton. Now that remains. Now there's no moving or changing on that front.
So that was the floor price below which you cannot be selling, basmati rice. So that people don't sell non-basmati in the garb of basmati.
Right. And either way, you're looking at two categories. And basmati clearly is the cash cow. It is clearly the most in demand, the high value good, and that you don't want the quantity of that not serving our own Indian population before it being exported. So no changes as far as the basmati rice exports are concerned. But as far as the non-basmati rice exports are concerned, we are able to sort of relax some of those curbs, and that too need-based for key and strategic partner nations. No need to misunderstand this for just us opening the doors all over again. Where there's a need, we will export non-basmati rice, but basmati rice is still a no-go.
Absolutely. And while we talk about the export curbs on rice, it's also important to talk about some of the headlines that the story made in international press, where they accused India of exporting India's inflation to the rest of the world, to the food basket in the world, because India is one of the largest exporter of rice in the world. But essentially a point that many of these publications missed was that India needed to cater to its own food basket first, its own needs to contain inflation first, its own need to have a buffer stock of rice. And now that it has built a buffer stock, it is starting to ease those measures.
Right, and it is true, but we're still at the early stages. We're talking about July 2023 when the export ban was first of all put in place. We are in December 2023. So, these are about 6 months to 7 months in which, we are seeing the progress. And since July, we've seen easing of curbs in the last couple of 2-3 months per se. And again, we're not easing the curbs to Western markets. We're not easing the curbs to America. No, we're easing the curbs to Asian and African markets, African nations who are key strategic partners to us.
Absolutely.
So in that sense, it's a very measured approach to even relaxing those curbs. So I would still wait and watch on this as to what's going to happen eventually with basmati rice exports. When do we have enough? How do we gauge it? Because at the end of the day, exports do get hurt if we don't, something like basmati, which is a highly in-demand commodity. So we'll have to wager our decision of when to reopen the exports eventually.
All right, the exports likely easing that we are looking at only with key specific partners, strategic partners in African and Asian nations at the moment, with 5 African countries, 1 country being a neighbor in Nepal. 240 metric ton of rice is the value. So a specific value of rice, non-basmati white rice, that will be now exported to these 5 countries, plus 1 are bordering Nepal. And shifting focus to China now. China, which has seen some sort of a slowdown in its exports and its factory output over the last 6 months, is seeing some turnaround after 6 months after all.
Right. We have to put this into perspective as to what is exactly happening, because so much concerns about Chinese economy, and also so much hope on, if China is going to be replaced by so many manufacturers and so many partner countries. So what's going to happen? Who's going to be the China plus one? So the question is, if you talk about Chinese economy bouncing back, the question is it the end of the entire China plus one dream? So let's put the numbers into perspective. Bear in mind, we're talking about the export number for November 2023. Exports, or what they call as overseas shipments, for the month of November 2023 in dollar terms is up 0.5%. That's what has happened. And that comes in when the median expectations from economists and analysts across the world was zero change. Okay. No increase in exports was what was expected. As against that, China has notched up 0.5% increase. And what kind of an increase is it? It's a year-on-year increase. It's a comparison with November 2022. So as compared to November 2022, in November 2023, exports are up by 0.5%. There in itself, there is a rider, because in November 2022, exports had contracted steeply in China because of them still recovering from the draconian curbs that they put during the pandemic days. Bear in mind, China was the last to come out of the pandemic, first to go into the pandemic and last to come out of the pandemic. So which means that by November 2022, exports had steeply contracted due to all the factory shutdowns that was witnessed up until the early stages of 2022. So in that sense, you had that number very low. So it's a low base effect also, which is showing up in November's data. But then again, it did beat all expectations of no change exports to 0.5% growth in exports. The story gets more interesting when it comes to China's imports. China's imports too has shrunk as compared to expectations of over 3% increase in imports. So in that sense, the data has been a good double whammy for China on both the exports end and the imports end. So hence comes the doubt that is China now finally out of the pandemic? Has it bounced back from the pandemic? Is it seeing the first green shoots of recovery in the pandemic? Bear in mind, November is not the only time when exports have ticked up. We've seen February 2023 too, in this year when exports did take up. But since February is the first time in November when the export data is up. So, that's why I had to give a layered answer to that question. So looking at the data, there is a low base effect that we're talking about, but then China belying all expectations that we're talking about, which means that maybe we need to reframe expectations. Economists and analysts across the world should reframe their expectations of what kind of data that they can expect out of China. And also, one more important factor contributing to this data is that exports are usually extremely high at the year's end during October, November, December because of the festive period, Chinese New Year, and also you have the year-end holiday, Christmas and holiday. So this season generally bodes well for exports from China. So it was not exactly a wonder that their exports went up. But putting all this in perspective, despite the fact that they weren't expected to notch up any gains, the fact that they did and they managed to shrink their imports at the same time, that's a good signals coming in from China's economy. All
right, good signal coming in. But then again, the big question of to what extent can you trust the numbers coming in from China that continue to be one of the riders again with numbers that are coming in from China. But as far as exports is concerned, it contracted last month. There's been a slight uptick, as you rightly mentioned, of 0.5%. When you put these numbers in perspective, is it looking that bright? Is it that bright? Because apparently factories are going in for discount pricing in China, which it is offering at the moment because there is a need to attract buyers.
As I said, we're not talking about some great growth in China. The question is that we thought this is going to crash, bang, boom. Like, contract, zero. Oh my God, China is over. And that's the kind of direction that we were going under. Hold your horses is what this data tells you.
Absolutely. Hold your horses. For people who are giving up on China, Chinese economy seems to be rebounding. What does it really mean for India? Let's also take a minute to talk about that, because China plus one strategy essentially meant, as you rightly pointed out, that China not doing too well for India, and so perhaps companies looking at an alternative in Asia, and India continues to be that one alternative, a bright and shining destination for people to come set shop in India, come set up factories in India and export from India. With China picking up slightly, does that dampen India's possibility of being China plus one destination, or does India continue to hold its prowess and its importance?
Right. At this stage, it's early. It's again early days to talk about it. But the fact of the matter is that the China plus one as a concept comes around not only just because of China's economy stuttering. We're talking about geopolitical tensions and geo-economic tensions that are leading into companies moving their base out of China. Talk about China's labor costs. When these companies once upon a time, 3 decades ago, 4 decades ago, invested in China, China's labor costs were low. Now China does not have the lowest labor costs in the world anymore. You have other economies. Vietnam, for example, has better labor costs. Bangladesh, for example, has done so well in the recent past because of the low labor costs. So there are other reasons to move out of China apart from its own stuttering economy. So in that sense, India, if you ask me, India has its own opportunity ahead with its own huge domestic market, not enough penetrated with foreign investments. There is so much more for India to contribute to, both as a manufacturing base, as an R&D base, as a business process outsourcing continues from India as well. So in many facets, India is has built capacities over the last decade or so to be China, more than China plus one, if you ask me.
More than China plus one. Well, that's the message coming in. Doesn't really hamper India's prospect to be an alternative, to be a manufacturing hub, a destination for global companies to come set up shop in India. But before we close this bulletin, very important story coming in by the way of a very popular painkiller, Meftal, that continues to be used for various, for various pains, especially by women for menstrual cramps. It now appears that it can have adverse reactions. That's the advisory coming in from the government. Unexpected, unanticipated, Krishna. As I said, a medicine which is so popular, especially among women, used by literally everybody I know, seems to have some sort of adverse reactions, and those reactions can be felt up to 2 weeks after you take the medicine.
Right, and it's anywhere between 2 to 8 weeks after you take the medicine. So this is a clear alert that has been put out. It has been issued by the Indian Pharmacopoeia Commission that is put it out over there. It was put on the 30th of November to be precise, and they've said that it can give adverse drug reactions, and those reactions can be severe rashes to many other symptoms that you will get anywhere between 2 to 8 weeks after you've taken Meftal. Meftal traditionally prescribed, of course, it comes under DRESS, D-R-E-S-S, drug reactions with eosinophilia and systemic symptoms. It's a severe allergic reaction to medicine. So it has been classified under the DRESS syndrome, that it's possible that if you consume Meftal, it's usually prescribed for arthritis, to fever, to dental pain, and other things, apart from menstrual pain, that is. So it's a clear alert over there. If you are somebody who does consume Meftal, you need to take a breather on it, because there's a clear alert that has been put out. And as you're rightly pointing out, in India, so many women end up taking a Meftal to deal with menstrual pain. And so in that sense, this is
it's an over-the-counter drug, so
yes,
you can easily go and access it anywhere. And women, more than anybody else, are the recipients of this drug. So perhaps an advisory to the women to be very careful. That's the message coming in from the government right now.
Right, and the symptoms have been put out as well: skin rash, fever. These are the ones. These are the kind of reactions that you could possibly get anywhere between 2 to 8 weeks, and this is generally under the category of adverse drug reactions. When an over-the-counter drug, as you rightly pointing out, can have such adverse reactions, and for such painful treatments for which it is even taken, it is very important that people watching this broadcast either go find an alternative painkiller, speak to their doctors, don't speak to over-the-counter people, just go consult a doctor, consult a physician, and take an alternative painkiller to Meftal would be the simple suggestion at this stage, Shweta.
Right, absolutely. So painkiller Meftal, they're not as useful as it appears to be, can have adverse reactions which could lead to allergies about 2 to 8 weeks after you consume that medicine. So talk to your GP, talk to your doctor, do not consume Meftal, do not buy it over the counter. Well, that is an advisory as far as Government of India is concerned. But with that, we've run out of time on this bulletin. Thank you very much for watching.
With all this gear, you must be wondering if I'm climbing a mountain. Well, let me give you a wider look of this place. This is Asia's largest mountain of shame.
A mountain of waste, almost the height of the